Okay, so for this strategy, you're going to have to use at least one higher time frame, and then you can use your lower time frame. So for me, and for this strategy, using the 4 hour chart, and then using the 1 minute chart, or whatever time frame you want to enter on, is such a money maker. So we're going to use the 4 hour chart, and what we're going to do is we're simply just going to mark out a 4 hour fair value gap. That's all we're using the higher time frame for. And if you look here, let me smart this out. This candle wicks high here, and this low here, this is your fair value gap, right? This right here is your fair value gap. And if you notice on the 4 hour chart, we wick into it twice, right? Now, all we care about is we just want to mark out the 4 hour fair value gap. That's all we want to do. And then we want to get in the lower time frames. And what we want to see is we want to see price respect the fair value gap. So imagine this is the 1 minute now. We want to see price hit the 4 hour fair value gap, quickly reverse off in the opposite direction, leave some fair value gaps here, and then we can enter on the retracement here, and then we can ride price up. That is all we're going to use for the strategy. So I'm going to get onto the 1 minute chart, and I'm going to show you exactly what the entry would look like. Okay, so here we are on the 1 minute chart, and if you remember, this is the 4 hour fair value gap. And if you remember what I just said before, what we wanted to see is we wanted to see price hit the 4 hour fair value gap, quickly move off, and then enter on some sort of retracement here, right? Ideally on a fair value gap, and then we want to ride price up, right? That is what we want to do, and that's what the logic of this trade is. And if we just remove this blue line here, right? Just look at this, right? Look at the respect. This is exactly what I mean when I say respect. Do you see how price wicks in to this 4 hour fair value gap and then quickly and aggressively reverses, right? Look at this. We come all the way down. We just wick into this fair value gap. We just tap it. We move off in the opposite direction, little retracement, and then we continue off, right? So we want to enter on any sort of fair value gap here. So if we just remove this blue I guess arrow, right? If we look here, we look at this wick here, the moment it comes in, it instantly reverses. We want to look at the first fair value gap that forms, right? The first bullish fair value gap that forms. And the reason we're looking for bullish fair value gaps is because this 4 hour fair value gap is bullish, right? That's the only reason we use the higher time frames. We're just looking for confirmation. So if we mark out this first fair value gap here, that's going to be our entry, right? That's going to be our entry. So this is the fair value gap. Let's just make this really obvious. This is the 1 minute, 1 min fair value gap. Let's make this a bit smaller, maybe a bit bigger than that, right? This is the 1 minute fair value gap, right? So what this does, and this is what's so important about the model, is let's move that there. We've got the 4 hour chart, which is our higher time frame. We have price respecting it because we wick into it. It moves off in the opposite direction, and it leaves a fair value gap. So any entry on this lower time frame fair value gap is very, very high probability, right? It's a very, very high probability entry. So let's just make this even smaller, right? Like that, right? So what you want to do now is we want to enter on this 1 minute fair value gap, right? And at this point all the way up here, right? If you get on the charts, you want to wait for the retracement to this fair value gap. So what that would look like is you'd set up your limit order at this fair value gap. Now your stop loss, this is dependent on the trader. The safe stop loss is at this wick low, right? Because this wick forms the fair value gap. I know it's a very long wick. It's up to you where you want to put it. But for me, this is a safe stop loss, right? You don't need it all the way down here. I would never say, and I always say to my students, don't have your stop loss really tight, because you see this wick here. This is exactly what so many students do, right? They get everything right about the model. Let's just zoom out. They get everything right about the model. So price comes in, it shows respect, it moves off massively, it comes to their fair value gap, but because they have such a tight stop loss, they get wicked out, only to see price go straight to their take profit. So don't be that guy. That used to be me. Don't be that guy, right? A 2 risk to reward ratio and a 50% win rate can make you a millionaire, right? You don't need perfection in these markets, you just need consistency. So for your stop loss, I would put it at this low here, right? This low right here. And we get a 2 risk to reward ratio pretty comfortably. If you aim for a 3 risk to reward ratio, you just miss out on it, right? You just miss out on it, which is realistic in trading, right? Every single trade, you're not going to hit a 3 risk to reward ratio or higher. Sometimes it's going to reverse on you. Sometimes you'll get 2 risk to reward ratio. Realistic trading, right? Realistic trading. And the only thing I would say is this, I guess, time of day, and this is in New York time, by the way, so let me just get this up. This is New York time. The only thing I would say is this is in between, so it's like end of Asia, and it's just before London, so that's why we don't get like the full 3 risk reward ratio. But you know, you can take trades in this session, right? Sometimes if I'm on the chart, I would look at a trade like this, but a quick 2 risk reward ratio scalp is more than enough. And if we just remove this here, you could also, now I'm not saying to do this, you could also enter on this fair value gap as like almost like a double confirmation, if that makes sense. Let's just zoom all the way out, right? And now this isn't part of the model, it's more advanced, but you know, if you're on the 1 minute chart and you're a bit of a risk taker, you can do this. But what it is price hits the 4 hour fair value gap here, right? It comes off, it respects it again, right? Because it moves off. You can enter on that retracement, right? And ride price up. So what that would look like is, let me just get this here, right? Remember, this is a lower probability entry, but you know, you can get a lot of trades. If you want to get, let's say, 2 or 3 trades in a day, that's how you would do it, right? So what you would do is, let's just mark out this fair value gap here. Like that. You can enter on this bit, right? You can enter, you know, here, but around here, when we've got, you know, the big bullish move off is what I would do, because I don't like this gap here. But what you would do is you could enter like this, right? And you'd put your stop loss either at this low here and get wicked out, or you can put it here and then aim for, let's say, these highs all the way up here, right? All the way up here. That's what you wanted to do, right? You wanted like a longer term play, but doesn't really matter, right? The first confirmation, so the first entry, let's remove this entry here, entering on the first fair value gap that forms after we touch the higher time frame fair value gap, that is the highest probability entry for this model, and it's what I've given you in the free PDF. So this was a bullish example. I know gold's been bullish for months now, but I'm going to show you a bearish example because the exact same principles apply, just in reverse. Okay, so here we are on gold, and this is a bearish example. Now, if you remember, the first one we do is we get on the 4 hour chart and we mark out our fair value gap, and in this case, it's a bearish fair value gap. So what we're going to do is we're going to mark out the fair value gap, nice and easy. And at this point right here, you can get straight onto the 1 minute or 5 minute or whatever entry time frame. The only thing I would say, for those who know, let's say they've watched a few of my videos, right here is your liquidity sweep. Now, if you don't know what a liquidity sweep is, don't worry about it. If you want to learn more about it, there's a full free 2-hour trading course on screen now. But if you know what a liquidity sweep is, look at this, right? Price comes down like this, bit of consolidation. This is just generating liquidity here. Price, see this wick here? Watch this wick right here where this vertical line is. This wick here takes out these stop loss orders and then quickly, aggressively moves in the opposite direction. That right there is your liquidity sweep, and it's on the 4 hour chart. So this is very, very significant. Yeah, just a bit of interesting price action there. So you've got the 4 hour fair value gap. What we're going to do is we're going to get in the lower time frames and look for our entries. Okay, so here we are, and we're on the 4 minute chart. So this is quite a, you might be wondering, why am I on such a weird time frame? What I do, and you'll probably see this in entry plan, is we look at the 4 hour chart. That's always fixed. And then your entry time frame, I usually look at the 15 minute chart. If I can't find a fair value gap, I go into the 5 minute chart. And if I can't find a fair value gap on the 5 minute chart, I go on the 4 minute, 3 minute, 2 minute, 1 minute. I never look at the seconds chart, for those who are asking. I never look at this. The 1 minute's the lowest I'll go. But ideally, the higher the time frame, and you've got a fair value gap, it's just an easier entry for me. So that's what I usually do. If you look at this price action, it's probably pretty obvious. On the 5 minute chart, there's no fair value gaps here. On the 4 minute chart, we do just about get a fair value gap here. So let me mark this out and show you exactly what it looks like. So like we said, let's just let me just mark this out actually. This right here, this big I guess rectangle, green rectangle, is the 4 hour fair value gap. This is the 4 hour fair value gap, which we mark out. So let me just let's put this in cap. This is the 4 hour fair value gap. We always wait for this. We always wait for this. We wait for price to hit it, and we want to see we're on the right side of the market. Now this isn't the best. Usually, I guess the reason for this is because we're towards the end of Asia, and just between end of Asia, beginning of London, expect chop, right? Same thing with end of London, and then going into New York, expect a bit of chop, right? It's just normal for price action to do this. This is the real move in Asia, this big bullish move. So let me just mark this out. Big bullish move into the 4 hour fair value gap. We consolidate a bit, right? Typical. London gives you the fake move, fake you to swing up into the fair value gap, and then we take out Asia's low, right? Typical price action right here. Accumulation, manipulation, distribution. For those who understand that, if you don't understand that, completely forget what I just said, because you don't need to make money. All you need is this model. So right here, it's the first fair value gap, first bearish fair value gap that forms, right? We're not looking at this bullish fair value gap. The whole reason we use the 4 hour chart is because it gives us our higher time frame direction. So we're not looking at any bullish fair value gap. We're only looking for bearish fair value gaps. And this right here is your first fair value gap that forms. So what you're going to do, you're going to mark out this fair value gap right here. And your entry is going to be at this fair value gap, obviously. You just about get it here. Again, this is the awkward time. When it's end of Asia and it's not the beginning of London yet. So you can take that entry, or you can get the higher probability, I guess higher volatility, higher volume entry during London, right? So right here, 2 a.m. golden time in London. I think that's 7 a.m. in the UK, 8 a.m. in Germany. And you're going to put your stop loss at this high right here, right? Now, for those who know, here's your liquidity sweeps. Let me mark this out. just like this, right? See this high here? Look at this high, right? Price comes up. Look at this wick here. Wicks up this high, moves down, leaves us the fair value gap. We can enter on it here or here. Put our stop loss right here, knowing that the only reason price came up here was to take out these stop loss orders. Very, very unlikely that price is going to come all the way up, take out your stop loss again, and then reverse. Very, very unlikely. So you don't need to know that, but if you do know that, and you see a liquidity sweep, and you see this entry model, you can make so much money. You can make so much money, it's insane. So, yeah, stop loss at this high here. Don't try and finesse your entries. I see so many traders, they get everything right. They try and put out this order block here, this fair value gap here, at this, this body here, just like weird entries. Just honestly, have a safe stop loss and then aim for a 2 or 3 risk to reward ratio. Right here, you get it nice and easy, right? 3 risk to reward ratio. If you were really confident and let's say you wanted to pass a prop firm challenge, now I'm not saying to do this, but if you wanted to, you could aim for these lows right here, right? Pretty easy Asia lows. So this is typical for London, right? So what happens? Asia makes the fake move into the higher time frame fair value gap. We consolidate a bit. You got your high probability entry, obvious liquidity there, right? Assuming you've got daily buys and all that sort of stuff. You can do that if you really want to. Now I'm not saying to do that, but some of you want to pass a prop firm in one day, that's how you do it. What's this about? Almost a 6 risk to reward ratio. If you just, here we go. So if you just zoom out here, here's your obvious, I guess, previous day's liquidity, if you wanted to target that. There you go. I mean, to be honest, if you really wanted to, what you could do, I'm not saying to do this, 'cause I always say aim for at most a 3 risk to reward ratio, but you could do this. You could aim for a 3 risk to reward ratio, like this, right? And then the moment it does that, you can move your stop to break even, or at least watch the charts very carefully. Because for me, I'd be out at this chop right here. Like, I wouldn't want to hold onto it. But if price is like dropping like a brick, like it is here, I guess you could just keep the trade open and just watch it. And then as soon as it starts to reverse, just close the position. But again, if you aim for this low, I mean, you almost get 8 risk to reward ratio, which is insane. And you've got a very safe stop loss. And yeah, that's all there is to the video. Let me know what you guys think of this new microphone. I bought a brand new microphone, so let me know if it sounds good or, but yeah, use that model. But what I would say, and I always say this, the entry pattern and the logic is good and all, but it's not enough to make money. To make money in trading, you need to have the mindset to go with it. So make sure you go watch this full free 2-hour trading course where I teach you everything you need to know about trading. And more importantly, towards the end of that video, I teach you everything you need to know about psychology, which nobody talks about, right? Reprogramming your mind, nobody talks about. So go check out that video, and I'll see you in that video over there.